Hello and welcome to Module 5. My name's Jeff Fitzpatrick, your tutor for this module. This is probably the most crucial of all the modules. Not the most difficult to understand, but definitely the most important to understand. Enjoy it and go through it several times if you need to. Support and resistance are price levels on charts that are revisited frequently. It's like bouncing a ball on the floor resists it going down further, the ball then goes to the ceiling and can't get through. That's resistance. They're invisible barriers to the movement of price in a particular direction up or down. Support is the lower barrier, the floor, and resistance is the upper barrier or the ceiling. Support and resistance can also form channels of the diagonal. I've drawn one on this slide. You could actually probably draw a couple of others if you want to look at it carefully. Your eye needs to get tuned into these channels and support and resistance levels. Support and resistance are useful and important because they help us to predict the direction and extent of price movements. In addition, old levels of support can become new levels of resistance and vice versa. Let's just look at that. What I'm saying is, what was support, i.e. the floor, following a downward price movement might go on to become the new ceiling, and vice versa. What was the old ceiling can become the new floor as prices rise. In addition, the longer the time interval on a chart, the stronger the support and resistance are. So for example, if you can see support or resistance on a monthly chart, that will be stronger than on a weekly chart. Similarly, support and resistance on a weekly chart will be stronger than on a daily chart. This will become familiar as we move forward. A particularly useful way of using support and resistance is to help to predict changes in direction of price movements. So for example, shown below is a movement of 71 pips, and that might be great. We may want to take the 71 pips. But if we actually look at a price chart, we could see that the 71 pip movement is not taking us to a new level of support or resistance, and therefore there may well be some more profit to be had in this trade. This slide illustrates another use of support and resistance. You can see that there has been price movement here of 71 pips from the bottom to the top of the movement. However, there were actually 1, 2, 3, 4 upward movements and 3 downward movements. And if support and resistance were used to enter and exit these trades, the gain could have been 4 times 23 pips, or 92 pips overall, instead of the 71 directional straightforward change. So again, using support and resistance can be a way of benefiting from multiple trades instead of a single trade. Some price levels form natural levels of support and resistance. We call these pivot points. Amongst these are whole number price levels. We saw this a little earlier. Levels such as 1.57, 1.58, 1.59, and so on. It's therefore a good idea to add lines permanently to your trading platform for all of the visible whole number price points such as these. Look at your trading screen for examples of whole number price points being used as support and resistance. You'll find there are lots of them. On this slide you can see how the 1.57 price point has acted as a natural boundary or point of resistance and support. The price has revisited this level many times, and also, even if it's passed through it, it's hesitated there for a while. So this gives us a good indication of what might happen as we hit a full whole number price point. This is not perhaps surprising, because what's happening are many people around the globe are making pricing decisions and buying and selling decisions based on whole numbers. They tend to do that naturally, and that collective action is making these points become pivot points. In Module 2, when you set up your trading platform, you included something called the Bollinger Bands. It's now time to use them as part of our study of support and resistance. They are extremely important to the Raven Glen way of trading, so this is a particularly significant part of the seminar. So here are the Bollinger Bands in place. and this is a particularly useful slide. It shows lots of examples of how they work. Towards the left, for example, we can see how the price action has increased and bounced off the top Bollinger Band. It's gone all the way back either to the center line, where it's changed direction again, or cut straight through the center line and bounced off the bottom Bollinger Band. There's an area of the chart where we can see the price action bouncing just between the lower band and the middle, and there's also areas of the chart where we can see the price action hitting the bottom, turning around and going back through to the top. All of these things are extremely useful for us. If we know that there's a high likelihood of the price changing direction when it hits a Bollinger Band, we can begin to understand how we can use that in action. We do need to refine it though. We do need to put some rules around how that works, because we don't yet see exactly when it's going to bounce off one of the lines or go straight through it. The big problem with the Bollinger Bands is that the price action does not always bounce off one of the three lines involved, the top, bottom or center line. Sometimes it walks along the line, so it actually goes against this and just takes us in a different direction to our expectation. For this reason, many traders don't use Bollinger Bands, so we have to find a way of overcoming that difficulty. So here we see the Bollinger Bands on a 1 minute time scale, and the price action is clearly at the bottom Bollinger Band. The question is it going to bounce off and turn around and go up, or is it going to go straight through? Well, if we look at the 5 minute time scale Bollinger Band chart, we can see that there's actually a good space between the price action and the bottom Bollinger Band there. The likelihood therefore may be that the price will continue to go down on the 5 minute chart and therefore go through the bottom line on the 1 minute chart. So we'd be pretty wary about expecting this price to turn round and to go back up at present. However, we'd then look at the 15 minute chart, and we can also see there that we're at the bottom and that the likelihood may well be that it's not bouncing, it's about to start walking. We can see that the price action has turned a corner and is heading a little further down. Given that, we might then look at some other price action timescales to see what's happening. Here is the 30 minute, and the price is on its way down between the middle and the bottom line. Again, a negative sign for us. And here is the 1 hour chart, same situation again, but not fully developed yet. So looking at these Bollinger Band charts and using the different time frames, we can begin to get an idea of when a walk or a bounce are going to occur. It's extremely important to us. The next aspect of support and resistance I'd like to talk to you about is known as Jeff's lines. A bit embarrassing, but there we are. And these are some aspects of trading that are known quite well throughout the trading world, but I think possibly I've enhanced them over the last couple of years. For many months, in fact for years of observation, I looked at price levels and found there were certain points at which the price naturally tends to change direction. Strong pivot points that are not whole numbers. These levels are always relative to the day's opening price. That is the price at 10 o'clock on the evening before the day of trading, UK time. So just to recap on that, with Jeff's lines we've got pivot points at plus and minus 75, 100, 150, and by the way also infrequently used, but at 200 pips away from the 10 o'clock in the evening UK time of the previous day. They're quite remarkable and uncanny how these pivot points work. In addition, I also note that the 50 pip level plus and minus is also important. In general, I don't accept that a price is moving in a particular direction for any given day until it has moved by at least 50 pips away from the previous night at 10 o'clock opening price. This slide shows Jeff's lines in place. So the green line, the vertical green line, is the 10 o'clock on the previous evening opening of the market time. The horizontal green line is the price at 10 o'clock last night, and you can see purple lines either side of the green line. That represents 50 pips plus or minus. Then to the outside of both of those we've got 75 pip red lines, and thereafter again 100 pip red lines. We can see that the price came down from the opening through the purple line, so confirmed that it was actually going beyond 50 pips in a downward direction, and it turned at the 75 pip line. The 75 pip acted as a pivot point. Interestingly, you see the price then rose again and actually turned at a whole price number before coming to rest, at least temporarily, on the 50 pip line. So you can see that between Jeff's lines and whole number price points, we've got some very strong pivots acting here. This is central to how I trade. This slide shows some of the observation that I undertook during 2010, and it shows the daily movements from the opening price of 10 p.m. on the previous evening, and you can see how many fall within 100 or 200 points on here. I actually took this further and looked at the amount of movement that was within 50 points of the opening price, 75, 100 and 150 points of the opening price. And I determined that the price regularly stays within certain bands and frequently uses those points 50, 75, 100 and 150 as pivot points. Here is another example. Again, the green horizontal line represents the opening price of the day, and you can see we've got a 1.58 whole number marked with a blue line. The price moved away eventually from the opening. It hesitated around the whole number at 1.58. It cut through the minus 50 pips, therefore confirming its downward mode of travel, hit the 75 pips below opening, used that as a pivot point, bounced back up, used the whole number again, this time as a pivot point, to come down, hesitated at the 50, the minus 50, before cutting through it, and in this occasion cutting right through below the 75 and eventually coming towards the 100 points away from the previous night's opening. That's more than coincidence, and you can see that just about every single day on the real charts. What I noticed from my months and years of analysis of price movements was that 70% of trading days saw a price move by 75 pips or fewer in one direction. On 20% of the days we saw the price move between 75 and 100 pips in a single direction. And on 10% of days, only 10% of days that is, the move was between 100 and 150 points in one direction. There were larger moves than 150 pips in a single day, but they occurred in only 4 days per year. Obviously there's room for error, but it's going to be very few days in a year. And when it did, it tended to move the 200 pip line away from the previous night's opening price as a pivot point on those occasions. As with all things in trading, Jeff's lines are not an exact science. They're very good, but being a proximity to a support or resistance line is enough to trigger a response and a change in direction. That's true of whole numbers, Jeff's lines, and support and resistance in general. Redrawing daily the plus and minus 50, 75 and 100, 150 lines can be automated through the purchase of software from the Raven Glen website's online shop. Note also that we don't usually bother to draw in the plus and minus 200 pip line because of the low number of uses that it gets during the course of a year, but it is something that I keep at the back of my mind. As exciting and useful as Jeff's lines and whole number pivot points are, I don't want anyone to forget about our good old friends, the Bollinger Bands. I'm just returning to that subject for a short moment to cover an aspect of the Bollinger Bands that I think you'll find interesting and useful. That is the squeeze. You may have noticed that frequently, irrespective of the timescale of the chart, a squeeze pattern will occur where the two lines become very close together. Some are short-lived and others seem to last a lifetime. They're very long. In all cases, however, a squeeze predicts a big move in price. Let me just repeat that. In all cases, that is, in every case that I've seen to date, a squeeze predicts a big move in price. The trouble is, no one, not even John Bollinger, who invented Bollinger Bands, knows which direction that move is going to be in until it happens. So I like to use a combination of Bollinger Bands and pivot points to determine where I think that the price is going to move. As exciting and useful as Jeff's lines and whole number pivot points are, I don't want anyone to forget about our good old friends, the Bollinger Bands. I'm just returning to that subject for a short moment to cover an aspect of the Bollinger Bands that I think you'll find interesting and useful. That is the squeeze. You may have noticed that frequently, irrespective of the timescale of the chart, a squeeze pattern will occur where the two lines become very close together. Some are short-lived and others seem to last a lifetime. They're very long. In all cases, however, a squeeze predicts a big move in price. Let me just repeat that. In all cases, that is, in every case that I've seen to date, a squeeze predicts a big move in price. The trouble is, no one, not even John Bollinger, who invented Bollinger Bands, knows which direction that move is going to be in until it happens. So I like to use a combination of Bollinger Bands and pivot points to determine where I think that the price is going to move. Well, that completes Module 5, and before we go I just want you to be able to check your understanding of what we've been through. Go over the material again if you need to.